just start out by saying that I've been in the real estate industry now here in the United States for 25 years this year. And if there's any single factor that has been emblematic of the change in the real estate industry, and in particular the capitalization of the real estate industry, it's been the same as for a lot of other industries, which is globalization. Capital for real estate flows in and out of the United States and other countries in a way that was almost unimaginable when I first got into the business. And so I hope we'll get an opportunity to explore that and talk about that on this panel, because it has a profound impact on how things get done now versus a generation ago.
That's great. Mounib, back to you.
Yeah.
Initial thoughts.
Well, you know, capital follows opportunities and safe haven. So whenever there's an opportunity and whenever people try to find a safe haven to place their money, they go look for investment across borders. And I think these are the two main driving forces that takes you outside your country.
Okay. Matt, some thoughts?
I think it really matches a lot of what John was saying. I think it's going to be interesting during the panel discussion just to learn more about those capital flows, where they've been coming from, because everyone talks today about Asian capital and how it's influencing the built form across the world. So I think just diving a bit more detail in terms of what that Asian capital is actually looking to do will be interesting.
Richard.
Well, considering we were just purchased by CSCEC, the world's largest construction enterprise, we're getting to see firsthand that flow of capital and what it really means here in the U.S. What's interesting is, and hopefully we get into a little bit of a discussion about the expectations coming here to the U.S. and some of the techniques that we use for construction and some of the costs associated with it, and how that influences somebody's decision on an investment.
Great. You know, I think one of the drivers that we see is that there's really a new global circumstance that has arisen out of the growth of the Asian economies over the last 15 to 20 years. So liquidity has been accumulating and has increased in markets like Korea, Taiwan, and mainland China. I think sitting in Shanghai, where I look after our design and construction business, one of the things that we've also seen when you talk about investing inside borders, that we've been able to raise domestic capital for projects. When we started our business in China, we were doing all of that work with offshore funds. Within a few years of us really beginning to execute, we, through the same channels of investing, were able to figure out that we could raise money on shore. So work now we're doing in China, we're doing with both onshore domestic Chinese capital as well as offshore capital. So it's an interesting development. We spend as much time using the relationships that we've developed since 2006 in China to talk about our business globally. Tishman Speyer has been able to do things like we sold a building in Brazil to China State Grid. So this globalization, it's a pretty amazing fact that we're kind of living every day. So let's go on to some questions. So Mounib, when we look at investing from a Middle East perspective, both onshore in the Middle East region itself and then going offshore into other markets, talk a little bit about the perspective of how the funds are flowing into those two arenas.
Well, funds are flowing towards the Middle East and outside the Middle East. And again, the investors look for opportunities. Local investors in the Middle East now are investing in their countries, especially in Saudi Arabia, where there is a big amount of capital available for investment. And many of the Saudis now are investing post 2008 and the 2001 period. Most of the big investors decided that we lost money with Lehman Brothers, we lost money with so many big companies around the world. Why don't we only made money in our countries. And this applies to Kuwait, applies to Qatar, applies to these countries. On the other hand, each one of these countries have sovereign funds. So this at the government level, they go outside and they invest in many trophy assets around the world. You hear about it all the time in the news, but there is lots of investment around the world in different industries and in real estate in particular. This is also on the government side, and it follows also on the mega investor, be it personal funds or family funds or funds as such that are geared towards international investment. The flip of the coin is that many European American companies, and I know some of them that are around here also, okay, are seeking opportunities, are trying to diversify their investment, and they're seeking opportunities by investing in Saudi Arabia, investing in the UAE, investing in Qatar. Other countries are investing in countries where the economies are open and governments are giving incentives and opening up, like Egypt also, and Jordan, and these places. So there is an inflow of capital and there is an outflow of capital. And bottom line, everybody looks for opportunities. Everybody looks for a diversification of the portfolio and the risk.
Okay. So John, we were talking before we started about the Hudson Yards project and Related's approach to putting together the financing for that. Could you talk a little bit about that?
Sure. And I think Hudson Yards and one of our other notable developments, Time Warner Center, also here in Manhattan, probably are good case studies and sort of show the way the market has developed over the last 10 to 12 years. Before that, for those of you who have not already heard a presentation on Hudson Yards as part of this, or haven't toured as part of this event, just to give you some context, Hudson Yards is an approximately 28-acre site on the west side of Manhattan, in which Related is in the process of developing just over 17 million square feet of commercial, residential, and other uses. Now, this type of project, having been personally around the world over the last 25 years working on real estate deals or raising money for real estate deals, I've seen these types of major mega projects in a lot of other places in the world. I've never seen one in the United States. It's the only one I've seen on this scale in the US. It's almost like having a project that you would normally see in Shanghai or a redevelopment in the middle of Tokyo plopped into the west side of Manhattan. So it's a little bit different for New Yorkers. Right now, the first portion of the site, what's known as the Eastern Rail Yards, is under development. So that's over 5.6 million square feet of office in 3 towers, all under construction today. 1 million square feet of retail on 7 levels, under construction today. 2 residential buildings of about 1.5 million gross square feet, as well as about another half a million other square feet of hotel, cultural, and other uses, all going on at the same time. Again, not atypical in other parts of the world, but in New York, pretty unusual. So in that project, right off the bat, we're partnered with the subsidiary of a Canadian pension fund. Our 50-50 partner in Hudson Yards overall is Oxford, which is a subsidiary of the Ontario Municipal Employees Retirement System. So that in and of itself is emblematic of the internationalization of the capital for a project in New York. In each of the buildings we build, we with our partners at Oxford, then go out and find partners, equity partners, to come into that individual building. That's the strategy, that's the approach that we've taken. And it allows us to match the best investor at the time for that specific project and the specific attributes of that individual asset. And we have, just on the Eastern Rail Yards, a really interesting mixture of non-US and US investors. We have a US pension fund asset manager. We have a sovereign wealth fund out of the Middle East. We have a property company out of Asia. And we've just recently signed up, although the deal's not final, at least a letter of intent to do another one of the buildings with an institutional financial company also out of Asia. So you sort of have a truly mixed bag, a truly global mix, right in just this one, radius of about 6 square blocks in New York City. Now contrast that to 15 years ago when we were doing Time Warner Center, There, it was a much simpler, setup. It was related, and it had one partner, which was called Apollo Real Estate Advisors, which, ironically, as it turns out, I was a partner at Apollo Real Estate Advisors at the time, which is one of the reasons I got to know Related so well. The fund at Apollo that we were managing that invested equity alongside Related in that project was dominated by U.S. pension fund and other institutional investors. Maybe 20 to 30% of the capital in the funds that invest in that project were from outside the U.S. You contrast that just as recently as a dozen years ago with 80 to 90% of the capital coming from within the U.S. for a U.S. project to today, where probably 75% of the capital is coming from outside the U.S., most of it outside of North America. And that's before we even get to the banks who are doing the construction loans. So in order to create the construction loans to actually build these buildings, which is 60 to 65% of the capital that comes into these buildings, we've literally had to search around the world for every type of financial institution and financial institutions from countries around the world. So we have a non-bank specialty lender listed on the public markets here in the United States. We have a private hedge fund style investor in another one of the construction loans. We have another loan that's led by one of the biggest banks in the US, but that has a syndicate of banks from Canada, Europe, Asia. And then we have a whole nother deal that's led by a European-based bank that has a similar roster of banks from around the world, including a very heavy dose of banks from China investing in that particular project as construction lenders. So I can't underscore it more forcefully that really it's truly an international project. And it's in marked contrast to where we were even as recently as 7 or 8 years ago.
Great. Thanks, John. So Matt, we were talking earlier about this uptick in cross-border investment. John just kind of mapped out what's going on with Related on the Hudson Yards. Is this a trend that's going to continue? You know, how long is this going to last? What do you see out on the horizon?
That's a very good question. I think the first thing we have to look back at is say when you look at a global level, international flows of capital has actually been going on for quite some time. In this year, 2015, we expect when we look at the global turnover of commercial real estate, which we think would hit around $750 billion, we expect around 50% of that to be cross-border transactions. If you look back to 2006, that was probably already at about 35–40%. So we've always had this cross-border transaction flow, but what we haven't really had until today is the absolute diversity and the real, I think, just as John's gone through there, summarizes it perfectly. There's capital from across the globe, whereas previously you'd see flows, but it'd be dominated by one particular region at a point in time. You can see David from Argent sitting in the audience here today, and if you look at the history of London has always had a lot of international capital, but it's been related typically to one region, whether that was the Swedes, whether that was the Japanese, whether it was North American capital. Whereas you look at it today, where about 70% of London transactions are done by non-UK investors. It's from across the globe. Now, the question which you're saying is, how long will this carry on for? And I think this is a debate for the panel and the audience, but I think you have to step back for a moment and just look at the tremendous amounts of global savings which are being built up. There's a study that's been done which says by 2022, there's an expectation that global savings will reach around 37 trillion. Now, if you look at where that growth to take it to 37 trillion is coming from, it's coming from a lot of, you could say, developing or developed parts of the world. So if you look at China, China's gross saving rates are going to grow at around 16–17% per annum. Indonesia, about the same rate. India, about the same rate. So you'll look in 2022, China alone could make up about 39% of total global savings. So I think if you step back and you look at it and say, you've got the emergence of new classes, new middle classes, a lot of an emergence of propensity to save. When you see this amount of capital that's been put into the financial system, it has to go somewhere. Now, today, real estate is looking very, very attractive. Everyone knows that real estate tends to be a cyclical business. But I think Today, when you look at it, it's attracting a vast majority of that new capital that's being built up because a lot of the new savers have an affinity with real estate. But I think if you look at, there's a study that was done by PwC, which said that today there's about 8 trillion that is allocated towards alternatives. By 2020, they expect that to increase to 15 trillion in terms of alternatives. Real estate is part of that alternative asset class. So I think the question of how long is this going to last, I think you have to sometimes divorce yourself from the real estate question and have to step back and say, are we entering in a generation where you've got a lot more emerging classes who are needing to save to provide for themselves in the future? And what role does real estate sit within that metric in terms of a different asset class for them to invest in? And it's now the role of real estate professionals to try and position real estate so it gets its fair share of that pie, if you so to put it that way.
Thanks, Matt. So, Rich, you like me, you're one of the builders on the panel here. So I'd like to pick your brain a little bit with your association now with China State, who is also our builder in China. They've done much of our work. What do you see is different about the approach to building tall buildings around the world? I mean, if we look at old buildings in New York and compare with what the work that's going on elsewhere, all over, you've got examples of the work that Mounib is doing, and there's plenty other projects on display this week. Talk a little bit about what you're seeing or feeling from your kind of new perspective with a global insertion into your business.
Well, I had the good fortune of going to Beijing right after the transaction took place, and I saw the 20 Hudson Yards being built in Beijing. I do thank Related for giving us the opportunity here in the United States to open that type of project up here. But when you look at a lot of the projects that are going on in China, and that's my point of reference, there's a blank canvas that they have to paint a picture. And you see some of these major projects along with infrastructure that was able to be planned, not having to work around existing infrastructure in a lot of cases. So, the environmental issues, the delivery of people, they're able to plan for, and I don't know whether or not that planning was good, but they had the ability to have that blank canvas to plan for it. In addition, when you take a look at some of the projects that are currently being done, and I'll give one example, the World Trade Center in Beijing, World Trade Center 3. When I visited the project, I was expecting, I wasn't sure what to expect actually. My thought about what I would see would be maybe not the greatest quality as we would see here in New York. Maybe not a focus on safety the way we'd see here in New York. But I was met with just the opposite. It's a complex building. World Trade Tower is 330 meters. And I was met with a project that had 120,000 tons of steel, and just for a point of reference, 11 Times Square that we finished a few years ago is 12,000 tons of steel. We thought that was a big building, a 1 million square foot building, but then you see these buildings with 120,000 tons of steel. Our parent company, CSCC, owns its own fabrication plant. They fabricated all the steel for the project. The entire project was done in BIM, and much of the project had prefab components that you would never see here in the United States. The project team on the job, which was very interesting, considering the fact that China was not a high-rise country until 25, 30 years ago. With the inundation of high-rise construction in the country, where do they get those management personnel for? And you see a lot of very young people, but large numbers of very young people all managing a discrete component where They've worked with the designers, come up with a delivery system, come up with a prefab system, tracked it through manufacturing, and some of the techniques that they've employed in China, we can learn a lot from them. A lot of the, tall buildings around the world are using techniques that we couldn't even conceive of using here in New York. We had these antiquated ways of doing business, a lot of it driven by unionism and by the limitations that it places on us. But it sort of opened our eyes to realize that there is a whole other world out there. We need to change our behavior, the way we're looking at things here in the United States. We need to adopt some of the best practices worldwide in order to be more cost effective and deliver a better building for less money. And we need to come up with ways to do it in a more timely way by prefabricating a lot of materials. So there's a lot to be learned. I'm looking forward to going back. We're now going to have an exchange program of management personnel with our parent company. And we're going to send some people to China, let them learn some of the techniques. We're going to get some of the people that have worked on some of these very tall, and there's a list of 10 buildings that they've done that are 1,000 feet plus, all very recent. And we're going to have some of those people coming over here to work with us to talk about techniques. In addition, and I think related, starting to look at their projects this way, we're looking at a procurement opportunity using our parent company to look for the prefabricated items at a less expensive way so that we can deliver a project economically, and related, starting to employ that tack themselves by buying subcontractors, building their own fabrication plants, and I'm sure they hope that they're going to save some money along the way.
That's great. So I'd like to turn to the audience. If we can get the mics ready. We've got some people here. I'm sure there's plenty of questions. We've got a good global spread of expertise here. So let's turn it to Barry. Question for the panel? It's not on.
Maybe I'm just talking quietly. We hear in the stock market how some of the global companies have hitting headwinds because of the U.S. dollar. I think one of the companies had a 15% hit to their dollar or to their profits because of the currency. How does currency affect some of the business decisions that are being made? Is somebody just losing because the Canadian dollar is dropping or whatever in these transactions?
I think,
Matt?
I'll take a go at it. I think each investor looks at things differently, but I would say the impact of the appreciation of the dollar has definitely had an impact on real estate transactional volumes. So if we look, if we look and say it's about $500 billion that's going to actually transact this year, if we look at our projections and we hit somewhere around $750 billion by the year end, that will probably be about 3, maybe 5% up on last year. If you strip away the dollar and you try and fix it against last year, we're 20% up. So you begin to see immediately sort of like the impact the dollar's had. But in terms of for investors, I think without a shadow of a doubt, I spent a lot of time recently in Singapore. A lot of Singaporean investors, very closely pegged effectively to the dollar. You've seen a massive desire for that Singaporean investor base who've had their own restrictions on their own growth within their own economy in terms of development-wise, to look to move outside. On the flip side of that, you see some other currencies, say for example, when we talk about, everyone talks at the moment about Asian investors and about China, quite rightly so. But if you look back and you go from 2004 to 2014, the biggest investor outside of their country over that whole period of time were the Germans. The Germans, without a shadow of doubt, along with the Canadians, they're the biggest, they're the mature, big investors who invest globally. A lot of the German investors today theoretically should be sitting there. They've taken absolute pounding, the euro versus the dollar, but it hasn't held back their investment strategy and their desire to invest more into the US. On the flip side to that, There is an argument which we've seen with some of, I guess I put it with some of the Asian currencies which have seen a decline. So from Malaysia, less so from the dollar, but the ringgit has declined against a lot of different currencies. You've definitely seen a turn off of the tap from Malaysian capital, which 4 years ago was driving a lot of the investment across Europe. And you begin to see some of those investors to take some of their profits which they've had and reinvest it back into their domestic market. So I think when you put currency in, each investor, whether it's from a sovereign to a private investor to an institution, has their own investment sort of strategies of how they're going to deal with the currency hedging or whether they will hedge it at all. But I would say at a sort of like an overall level, that actually the appreciation of the dollar hasn't really impacted in terms of decreasing the amount of investment. If anything, it's gone to a point and say, well, the appreciation of the dollar adds to the fact that why people want to invest in America, which is down to the fact that it's got proper growth and the fact that it seems to have a dynamic young population. And those type of factors support this appreciation of the dollar and makes it an even more attractive country to come and invest in.
Great.
And I think,
Go ahead, John.
in addition to currency, there's another factor that's related with a small r, not a big R. And that's sort of volatility, global volatility in all financial assets. So as you see stock markets going down, fluctuating, it points out why places like the US and the UK are seen as attractive places to make investments in property. Safe havens where you can invest for long-term stability and growth. So one of the questions that was raised within my own firm over the last several months, as in particular the Chinese markets were selling off, was are all the discussions we've had with potential investors out of mainland China, is that all going to evaporate? Is there going to be a turnaround and the investors will refocus all of their attention on their domestic marketplace because of the decrease in the stock markets? But if anything, we've seen the opposite. We've seen a resurgence, or at least a continuation, but potentially a resurgence and even an increase in interest in diversifying on the part of these investors, whether they be property companies or institutional investors outside of mainland China into places like the U.S.
John, I'd like to add, we had a meeting recently with a couple of major Chinese banks, and their point-blank statement was that they think that it's actually going to accelerate in the near term and midterm. And in recent months, I've actually seen a increase of activity from new investors coming to the United States, and fortunately have a good entree to the new investors, and we're seeing an acceleration right now.
Great. You got more questions? We've got one here.
I'm Hakan Azneci with Clayco Construction out of Chicago. I have a question for Matt. He mentioned you saw quite a bit of investment from Germany in the US. Was that mostly in industrial, real estate, or commercial, residential? And also talking about cross-country investments. What are the trends recently? Is it mostly residential? Thank you.
The definite preference for the German institutional investor is actually just offices. It's principally, I don't know the facts of what the percentage is, but it would probably, the best part would be 90% office investment. There is some multifamily, which they begin to invest into, but they struggle with multifamily. Industrial, interestingly, is just a sector which has just become on their radar in terms of an asset class to look at, principally because they've seen a few transactions, and when I'm saying they, I'm talking of the likes of Union, Deutsche Asset Wealth Management, Decker. They're all beginning to consider an industrial strategy with build-to-suit properties across the US because they've seen such compression within the yield or the cap rates within the office sector. They believe that they can get closer to sort of like a 6 cap if they can move into that build-to-suit and get long leases within that sector. So as a general, offices moving in towards industrial, it's like the way they're moving. Retail, very limited.
Hi, David Partridge from Arjun. I'm just interested to ask the panel. It all seems to be very rosy, and it's going to carry on for the next 5, 10, 15 years. But where do you guys see the risks? Because obviously there are risks out there in terms of not just the property side of things, but as you say, the global view. Is it around different taxation regimes? What's going to stop the golden goose from keeping on laying those eggs? Because I'm sure each of you have got a different view from where you're coming
We'll
from.
send it across the panel. So where do we see risk? How long do we see this going on? What are the factors that start to change the environment we're in? And Mounib?
Well, I think practically most important is interest rates. At these levels of interest rates, people look for, investment that would are secure and yield higher levels. Okay? Then there are market forces, the movement in the different economies in the world. Going back, for example, to the status of the currencies, with the low interest rate today, the market is adjusting horizontally and vertically to the flow of investments. People who are waiting, big global players are looking for investments now in cheaper currency, in countries where you have cheaper currencies. So they readjust their portfolio accordingly. More important, I think, is downstream, on the horizontal level, the smaller, the individual investors, which form at the end of the day, we don't speak about them much, but when you're in the international investment, real estate investment in many countries, okay, you look for international investors coming from different places of the world to buy apartments or buy property or buy income-producing properties in safe havens. Okay.
So the downstream
exactly.
side of
So
it that
I
we
think
talked about this
downstream
morning,
makes the upstream, shift. For example, today, many people are aiming to buy properties in Europe, be it in big cities or smaller cities, because especially people coming from Africa, from the Middle East, from Eastern Europe, and from the US. So now is a very good opportunity to do that, with a weaker euro. A few years back, Europeans were buying assets in countries like the Middle East, and in Dubai, for example, or in the USA. So I think one has to look at these opportunities from a global perspective, and upstream at the global level, where you see these big players coming to do these major investments in different places in the world. And how is the movement of the downstream of the smaller players? And I speak about the area which is between the Middle East and the USA, and fed by Africa and Eastern Europe. Okay? I'm sure in the Far East, they have the same, the same perspective.
Sure, great. So John, I think Mounib touched in the beginning about interest rates. When interest rates begin to move, how big a risk is that to what's going on with the global investment pattern for real estate?
Well, I'll touch on interest rates briefly, and then we'll move on to sort of what I think are two very differentiated risks, at least in the U.S. market. Okay. With regard to interest rates, which is really applicable primarily to existing stabilized leased property and where that trades in New York or London or Tokyo or anywhere else. Yeah, Mounib is absolutely right. That's the fundamental risk factor that's out there, because at least in the U.S., there has long been a perception that interest rates can't possibly stay as low as they are indefinitely. Now, if you look at the example of Japan, there's an industrialized economy where they have, but I think everyone's hope would be that the U.S. market would return to an era of growth and stability where rates could be a little bit higher, and and so everyone's expectations continue to be that both short-term rates and long-term rates will rise. I think there's a little bit of a buffer in the U.S. market where there's still a spread between cap rates on stabilized property and where 10-year treasuries are that is, if not, well, it's still a little bit wider than the historical norm. I mean, back when I was first getting into the business, I mean, if you look just prior to when I entered the business in the 1980s, places like Europe and the U.S., you actually had negative arbitrage on real estate investments. People would invest at a 9 and they'd be borrowing at 11. And there's actually a lot of developing countries around the world where that is still the case. So on a long-term historical perspective, if you have 200 to 250 basis point spreads between the cap rate for a core stabilized property over the 10-year, you have about 100 basis points of buffer before there's real sort of panic in the marketplace in any way. What I would say, though, is the risk factor for projects, let's look at our company. Our company builds projects and holds them long term and occasionally sells them. The risk for us is, in a lot of ways, it's outside of real estate. Just as it was in the global financial crisis, it wasn't real estate that caused the global financial crisis, at least not commercial real estate. Maybe it was residential real estate in the U.S. and other places. But the financial markets basically shut down, and you couldn't finance real estate or anything else for that matter. And so a shock from outside the system, potentially can have a real impact on our industry. I think it's a short-term impact. I think we sort of make our way out of those dips every time they occur. And I agree with the sentiment behind David's question, which is, trees don't grow infinitely to the sky. We are in a cyclical world and we're in a cyclical industry. So what we do it related is we spend a tremendous amount of time making sure we have everything nailed down before we get too far out ahead of our skis. That we make sure that the financing is in place. We make sure that our procurement is organized. So for each one of our projects, it can be completed and can be stabilized even in a market which itself may not be stable. The third thing I would just touch on is there's this whole other market, and it's a little bit specific to New York City, but it's worthy of note because we're all sitting here right now. You have this very new phenomenon, and it's tied directly to very tall buildings, and it's these residential buildings here in New York City, the likes of which we've never seen before. Residential condos focused on a corridor that roughly runs east-west on 57th Street, now dubbed by the journalists as Billionaires Row. And I think there's a risk factor that I personally can't quantify, but I think a lot of people think is out there, where there are these condominiums selling predominantly to non-primary buyers, people who are not actually going to live in the apartments, at least for any considerable portion of the year, being sold as investments. I mean, what could be more fun than having a $30 million investment in New York City that you actually live in a couple of weeks a year? But there is the risk that either through things that happen geopolitically or interest rates or a lot of other things that we can't anticipate, that the number of non-U.S. investors willing to buy those 30, 40, 100, $200 million apartments in New York City, that group sort of dries up, whether it be gradually or sort of like a light switch being turned off. And that'll have a real impact on those particular buildings. It's a very specific stratum within the market, but it's very visible, and it's going to get a lot of headlines if it happens.
How much does it represent from the total market, and these high-end apartments? Because at one point, I worked with GLL on projects in Monaco, and in Monaco, they tell you a square meter is 65,000 euros, 70,000 euros. And we discovered at the end of the day, there is 1-2 transactions a year at these levels, whereby you have hundreds of transactions at 1 million, 2 million euros with foreigners. So how much does this, these transactions, which is $200 million, $150 million apartment sold to foreigners in New York, represent from the global real estate market of condominiums?
The $100 or $200 million transactions are a very, very small subset.
But they're headline grabbing. Right?
But the apartments that are being marketed, and some of which are being sold at, let's call it a benchmark for today in Manhattan. Someone who lives in New York is going out to buy an apartment and they want to buy in a new building. They're going to pay in most neighborhoods something like $3,000 a foot. Now these mega towers, they're at $6,000, $7,000 to $10,000 on a per square foot basis. right? So you're talking about a 3,000 square foot apartment that's a $25 million transaction size. And that's actually the volume. There's thousands of these units being released into the market today and over the next several years. And it's never, ever happened before. The record, the highest price ever paid for an apartment in New York City, for a condominium apartment in New York City, when we were doing Time Warner Center, was a $40 million apartment sold to an individual, a hedge fund guy, right? And that was one transaction out of the whole market of thousands of transactions in New York City. Now you have hundreds of these transactions out of the thousands in New York City. And you're right, there are hundreds and hundreds of billionaires around the globe who might want to have a $50 million pied-à-terre in New York City. But like I said, it's an unquantifiable risk factor, and it's not going to be good for our industry if some of those buildings start having difficulty.
You know, but if you go one step further in your discussion, when prices in one location in a city are established at $10,000, $20,000, $30,000 per square meter, and you find it very high, immediately other area, which is a little further away, within the city, try to flourish. Like, now we're hearing about development on the west side of New York, downtown. I've been for New York for a long time. Did not come to New York for a long time, and historically it was all midtown, uptown, midtown. This is where all the action was. Since yesterday and today, I discovered so many new areas that have flourished very successfully, because of the excess prices or the high demand in the historic area, the traditional areas. So in terms for government officials and for the economy, I think when you have this concentration of, yes, same in London. For London, we have you go to One Hyde Park. They sold the square foot at 10,000 pounds. Okay. But automatically, if you go 2-3 miles in every direction, prices go down. But these areas have flourished seriously. Okay. This is the other part of the coin. So you say there's a risk on the economy that a few billionaires are coming to buy a limited number of apartments, 100, 200,000 apartments being generated on the market by these super tall towers that are being built. And there is a risk on the local economy. But at one point in time, many other areas around the city have developed. I don't know if Queens have developed, Brooklyn has developed during this period because of the growth in Manhattan.
Yeah, I mean, although I will say that the growth of those areas is also tied to an overall shortage of housing in the New York system for people who actually want to live full-time in New York City. So that actually I'm reasonably bullish on, that there is market demand and that there's, for a lot of factors, land is expensive, most sites are already built out, affordable housing requirements for all the developments. There's a whole bunch of factors that lead up to a long-term, systematic shortage of both rental and for-sale housing in the New York system. So I think the New York City system, in all those areas, and thank goodness there are new areas like Brooklyn that are hot and are very desirable,
New Jersey,
to be able to absorb that demand. But there is this tale of two cities. These other buildings are kind of a different subset. And I don't think they represent systematic risk to the system. I don't want to imply that. I mean, I think they represent risk to the equity investors and developers of those buildings who are, ought to be prepared to face those risks.
But if these buildings have not been built, I don't think you would have known that the market is ready to receive investors of this caliber. You have to make the product available.
And yeah, you're right. It's good for everybody because if someone's buying an apartment on Park Avenue in between Park Avenue and Madison Avenue on 61st Street, and they're paying $7,000 a foot, our development at Hudson Yards at $3,500 a foot is going to seem like a bargain.
I give you my experience. For example, in Jeddah. Jeddah is a flat city. It's a highway city like Los Angeles. Everybody lives in houses. And today, the city has grown so wide, there is a serious need to have a city center, a place to anchor the growth of the city and to reduce the traffic, the travel time. And the only way to see if we can sell these apartments that you're building in our tower is to build the tower.
Right.
Let's move on. Matt, your comments on risk. Where's trouble brewing?
Yeah, I think John covered a lot of them. I mean, so I'm going to touch on something else, which I think is a really simple one, really, which is sentiment. Because I think we're beginning to see, I don't know if we're seeing, I hear less of it from the US, but if I talk to London, look at London at the moment, which has been, a massive success story, the commercial property industry is beginning to talk itself into a crash. Everyone is saying it's got to go, it's got to go. Everyone talks about interest rates will push up, as we've heard, but as you've said, the spread is massive, and if interest rates go up, hopefully that will actually mean there's actual economic growth that's coming through, so you can have rental growth, which is going to offset the rise in the interest rates. So you look at those different components. But the reality is we're at record levels with the cap rates. We're at record levels now almost with the rental level. Everyone says real estate's cyclical, therefore there's got to be a crash. And we're beginning to see at the end of this year, the market in London, and less so across Europe, but within London, is getting flooded with what, be interesting what David's thoughts are, but I would say average properties at very aggressive pricing, which will not trade. And as a result, the market will start saying, look, prices are crashing. Well, they're not crashing. It's people who have been trying to achieve the wrong price for assets which are fundamentally flawed. But it'll be interesting to see what that sentiment, the negative type of sentiment, then spills over onto the wider real estate industry. And I think, we talked a bit about China here today, and we talked about the stock market crash. If you go and ask a broker in London about Chinese investors today, they'll say they're dropping contracts, left, right, and centre. They're pulling out of everything. It's about 3 deals they've pulled out of. And those ones they pulled out of, the reality is they were ones which were not taken in the correct manner to the Chinese authorities and the regulator for that capital to come offshore.
Technical route, yeah.
So technically they didn't approach it in the right way, is probably the reason why it didn't happen more than anything else. But again, people are grabbing hold of this and saying, look, you see, China's going. They're the people who've been underpinning the market. So I think one of the risks, obviously we've heard a lot of the other risks that are sitting there at the moment, is the real estate industry talking itself into it.
Great. Do we have other questions? Any other comments, guys? Any other topics you want to push into? If not,
I would just note that for several $100 million of our project at Hudson Yards, we've actually raised the capital $500,000 at a time through individual investors from around the world, but mostly in China, investing in our project under a program known under the U.S. Immigration Code as EB-5, where you can make an investment in the U.S. But also have the opportunity to have to achieve a permanent work visa in the U.S. It's something that 10 years ago no one even talked about in the real estate space, and now every time you see a new project, everyone says, "Well, is EB-5 applicable to this?" So that's another change that's gone on, and one that we've been sort of in the middle of.
But this is also very fashionable around the world. Many European countries today, they just tell you, come invest 300,000 euro or €1 million.
Australia's got a program.
And you get a permanent residence in no time.
I mean, the first time I really saw it was right around the time of the handover of Hong Kong, where it was very, Canada had a big program. And a lot of Hong Kong Chinese were looking to make investments in Canada to get a Canadian passport just in case.
Yeah, this has always been the case in Canada, but after the recession in Europe, the problem, for example, you go to Spain today, you go to Greece, it's very easy, to Bulgaria, to Portugal. It is very easy to get if you just buy an apartment and you rent it out, and so it stimulates the economy, it stimulates the real estate market.
And they leave the real estate there.
That's right. Yeah. You don't take it with them.